Good afternoon from Bangkok and welcome to Minor International's 9-month of 2018 results presentation. My name is Supicha Fuwanan from the Investor Relations team. Today, I have a pleasure of introducing our presentation in which you will hear from Mr. Tatip Adunpan, Vice President of Investor Relations. The aim of today's presentation is to update you on the first 9 months of year performance and share with you our strategic directions and business outlook for the remainder of the year. I now like to hand over to Mr. Tatip for the presentation.
Good afternoon. We'll start off as usual with our performance recap and also on our newest acquisition, NH Hotel Group. And then we'll go into the operations of Minor Hotels, Minor Food, and Minor Lifestyle, and then finish up with the corporate information and our 5-year strategy as usual. So I'll start off with the 9 months recap. For the 9 months of 2018, we saw revenue increase of about 9%. That's primarily from the organic operations of the hotels and also the lifestyle business. And also in the second quarter and a little bit in the third quarter of this year, we also got the dividend income from NH Hotel Group as well. However, on the net profit side, it grew at a slower rate than revenue. So net profit was up by about 1%. So the margin was under pressure for the first 9 months of the year, primarily because of the Untitled Vacation Club business, which had revenues in US dollars, while costs in Thai baht. So because of the strengthening of the Thai baht, there is some pressure on the AVC business. And also because of the lower operating leverage of the restaurant business over the past 9 months as well. And we also incurred some interest expenses while we made the acquisition of NH Hotels. So there was a mismatch between revenue where we just got the dividend payment in the for the second quarter, whereas we had to pay for interest throughout the acquisition. Going into our international presence. So today we're actually in 64 countries, including the hotels under the NH Hotel Group. And if you look at our revenue today, 48% is from Thailand, whereas 52% is from international. So it is pretty much in line with our 5-year plan, where we'd like to see 50% of revenue coming from Thailand and another 50% coming from international. I have to say though that because of the NH Hotel Group acquisition, we will need to revise our 5-year plan, and we'll be sharing with everyone probably early next year once it's approved by the board. Now, I'd just like to update a little bit on the acquisition of the NH Hotel. So this is actually a transformational acquisition for us. So the transaction's been completed on October 31st of this year after the completion of the tender offer. So total investment amount is actually about 2.3 billion euros or about 88 billion Thai baht for the 94% stake in NH Hotel Group. So it's transformational for us both in terms of the platform and also the size of our financials. So just to kind of recap, I think if you've been following us, then you kind of know the numbers already. So in terms of number of hotels, we're actually tripling the number of hotels from 164 hotels just Mint alone to over 540 hotels with Mint and NH Hotel Group. In terms of number of keys, it's about from 20,000 keys to 80,000 keys. So that's pretty much like 4 times. And then in terms of number of our key owned brands, we have 5 currently. And then with NH coming in, we have 8 altogether. Number of countries increased from 40 to 64. Of course, a lot of that is in Europe and also in Latin America. And number of employees increased from 66,000 to over 89,000 employees. That's on our platform. On the financial side, we've also done an exercise of the pro forma of NH plus Minor International. So those are under the assumption that we got the 94% since 1st of January of last year. And there's no fair value adjustment yet as of the pro forma consolidation. And the borrowings from financial institutions and corporate bonds are calculated at about 2.2% interest rate. And the P&L does not include the interest expenses on the 15 billion baht bond of the perpetual bonds. So with that, you can see that in terms of revenue, we're actually almost doubling from about 47 billion baht to over 92 billion baht. In terms of EBITDA, it's up by 78% from about 9.7 billion baht to about 17.2 billion. And in terms of net profit, we're being conservative, so we're just taking the recurring net profit of NH, which is lower than the reported net profit because they had quite a lot of one-time gain as well. So just taking the net profit that's recurring, we're increasing the net profit from 3.8 billion baht to about 4.4 billion baht. So that's another 16% increase in terms of net profit for us. And in terms of the immediate plans of what we're going to be doing from the fourth quarter of this year and throughout the rest of 2019, we've identified about 3 main areas that we should focus on immediately. So the first one is operations. So we'll continue to support the management of NH hotels, just as we've always said since the beginning, with their original plan in terms of growth. In addition to that, we'll also drive integration plans in order to increase revenues and also make sure that customers get their highest satisfaction as well, and that will be things like sales and marketing or the working on the OTAs and loyalty programs. And the last one, as we've said earlier, that we'll start immediately working on the value creation and synergistic benefits between us and NH. And that could be potentially things like rebranding, whether rebranding some of their hotels into Anantra or rebranding maybe some of our hotels into their brands as well in order to maximize RevPAR. And also to start cross-selling, as we are more well-known in Asia, whereas they are more well-known in Europe, so we can cross-sell the customer base between us and them as well. That's some of the example. In addition to the operations, we are also working on the accounting side as well. So consolidation of the NH Hotel Group will be in the fourth quarter, probably in November and December starting in November and December of this year. And then next year, we'll consolidate the full year financial of NH Hotels. So that means we should be expecting net profit contribution in the high teens from NH coming into our P&L next year. And the last one, of course, is to manage our balance sheet position. So by the end of this year, we'll ensure that we'll comply with our debt covenant of 1.75 debt to equity. And by next year, we'll focus on, by the end of 2019, to bring the debt to equity level down to our internal policy, which is at 1.3 times. In terms of things that we will do to get to these DE ratios, the first one is, of course, the fair value adjustment. So just as with any of our acquisition deals, when we start consolidating the balance sheet, we'll need to consolidate the assets at the fair value. So that's already in progress. So we've already engaged a third-party appraiser to start doing the valuation for NH assets. In addition to that, we're also looking at issuing perpetual bonds as well. So we've just announced that we're starting to do the marketing activities for the issuance of perpetual bonds, and then we will, after that, we will evaluate the possibility of issuing the bonds. And going into 2019, other 2 things that we'll also be doing is looking at the possibility of getting financial co-investors, and we're also looking at asset rotation strategies. So that is also possible when some of our assets that we've acquired in the past have already started to improve and generate more EBITDA or more returns, so that if we sell them, we can also realize some profits as well. So that's things that we are in our plan to make sure that our DE level is at the disciplined level going forward. And just a little bit on the financing plan for this. So over the past three quarters, second, third, and fourth, we've actually been accumulating NH's shares. So that means our debt level, our debt has also been accumulating as well. So as the end of at the completion of acquisition, we actually have total investment cost of about 88 billion baht. And of that, we've already financed 15 billion baht through perpetual bond. And we've also issued about 80 million euros of bond, which is equivalent to about 3 billion baht. So the remaining 7 billion baht right now is being financed through bridge loans. So over the next 18 months, because the bridge loan has the term of about 18 months. So over the next 18 months, we'll be looking at ways to term out these the bridge loans. So it could be a combination of things. One is we could be issuing corporate bonds or syndicate loan or have syndicate loans. And also, of course, what I mentioned earlier is issuance of perpetual bonds, and also looking at selling to co-investors or asset rotation. So the bonds and the loans could potentially be in many of the currencies depending on the market condition at that time. But what we'll ultimately do is swap it into euros to close any foreign exchange mismatch. And because it's going to be in euros, that also means that we have the advantage of having the interest rate at a lower interest rate after doing the swap. So all in all, our blended funding cost, we're targeting that at less than 3%, including everything, whether it's perps, whether it's bonds, syndicate loans. Just a little bit of a recap on financial performance of NH Hotel Group. So they also announced their 9 months results, and the revenue is up by about 3%. That's primarily from RevPAR growth of about 2%, occupancy is up 0.4%, and rate is up about 1.5%. So the strong performance is actually from Benelux and Italy, and the relative RevPAR has actually outperformed the comp sets. And if you look at their recurring EBITDA, they actually saw EBITDA growth of about 9%, which is more than revenue growth. And so the margin actually improved by almost 1%, from 14.7% to 15.6%. So that's about 41% EBITDA conversion rate. And they've also had a lot of effective cost controls, both in terms of payrolls and also operating expenses. And if you look at their net profits, actually up about 88% for the 9 months. So from the improvement of the operations, and also from lower financial costs because they've been refinancing a lot of their bonds and convertible bonds as well. So at the reported net profit level is actually up about 4 times, from 24 million euros to about 107 million euros. And that is also from the higher contribution of the non-recurring gains, which is pretty much from their sale of some of their assets. So all in all, very good year for NH Hotel Group, and the CEO of the NH Hotel Group actually reiterates their forecast of 260 million euros of EBITDA guidance for 2018. Now going into our operations, so we start off with our financial performance for minor hotels. For this number, we've actually taken out everything that's related to NH Hotel Group, so that we can see the pure performance of minor hotels. So revenue of minor hotels is up by about 13%. So that's driven by owned and managed hotels, and also the consolidation of Corbin and King, which we acquired at the end of 2017. So revenue of the owned hotels up 26% from the organic operation of 11%, and the rest from consolidation of Corbin and King. Management letting rights, we actually saw revenue growth about 5% in Aussie dollar term. So that's in line with our RevPAR growth, about 3%. And we also had some increase in number of rooms as well. But however, because of the weakening of the Aussie dollar, if you look at revenue in Thai baht, it was flat compared to last year. Management contract revenue increased by 8%, so that's primarily from increase in number of rooms as we added and opened more hotels over the past 12 months. For mixed use, revenue declined by 7%, and that's primarily from the mismatch of sales activities for residential development, primarily in the first quarter of this year. So all in all, revenue growth was about 13%. EBITDA and net profit actually increased at a lower rate of 11% and 9%, primarily because of the margin pressure on the Anantara Vacation Club, as I mentioned earlier. If you look at in terms of contribution, today, Thailand contributes about 32% of revenues, and overseas contribute about 68%. And we're now in 53 countries on the minor hotel side. Going into the operation, the statistics, in terms of number of hotel rooms for the whole portfolio, we actually saw number of rooms increase by about 4%, and that's primarily from management contracts and also from management letting rights or OAKs in Australia. If you look at our organic RevPAR, excluding FX impact, it's up 7% in the third quarter of this year. So that's primarily from own hotels and joint venture hotels portfolio. But if you add new hotels and factor in the impact from the foreign exchange, system-wide RevPAR is up by about 1%. If we go a little bit into more detail, start off with the owned hotels, which is about 63% of the overall hospitality business. So this is like the most important segment for us. In terms of number of rooms, it's actually been flat because this excludes the acquisition of an H hotel. So this is like the organic operation of Mint. In terms of RevPAR, it's up 13% for organic RevPAR growth, primarily from overseas hotels. But if you look at system-wide RevPAR, it's up by 8%. And if you look at revenues of owned hotels, excluding NH Hotel Group, the revenue is actually up by 26% in third quarter. So both from organic operations and also from consolidation of Corbin and King, as explained earlier. Now, if we dice the owned hotels into Thailand and outside of Thailand, for Thailand, we actually saw RevPAR growth of 1% for the overall Thailand portfolio in the third quarter of this year. So it's driven primarily by hotels in Bangkok, as you can see from the chart. So it's actually from Bangkok, and while the provinces was about flattish or -1 in terms of RevPAR. In the third quarter. So Bangkok was driven primarily by hotels at the Riverside hotels. That's Anantara Riverside and Avani Riverside. The provinces a little bit slower in terms of RevPAR growth, primarily because of the impact from the Chinese slowdown. And because of that, our hotels, especially the hotels by third-party brands like JetBlue, Marriott, Phuket, were more impacted because they were more on the sort of like mid-scale, upscale, kind of like mass hotels. Whereas if you look at our branded hotels like Anantara, they were not as impacted because of the Chinese tourist slowdown. Now, going into overseas hotels, if you look at RevPAR, it's up 12% in Thai baht term. If you take out the foreign currency impact, it's actually up about 19%. So all the four key markets are doing well. If you look at Portugal, RevPAR is up by 12% in Thai baht term or 15% in euros. So hotel renovations were completed since the second quarter of this year, so in time for the high season. And for the first time since we bought the Tivoli portfolio, we actually saw RevPAR increase from occupancy as well as rates. Primarily before it's been from rates because we've been improving the products through renovations, so we've actually been able to increase rates. But this is the first time that we saw occupancy increase, so that means the hotels are getting traction. For Brazil, Thai baht term RevPAR is up 9%. In local currency term, it's up 37%. So both of the hotels, one in the Sao Paulo and also one at the beach destination in Bahia, both performed well. Maldives, we also RevPAR growth of 10%, and there's still a lot of supply in the Maldives. So the improvement on the RevPAR is primarily from occupancy, and that's pretty much from our marketing activities that we've done in the past, and we're seeing that feeding through, and we're seeing occupancy increase. For Africa, we're also seeing RevPAR growth of 15% in Thai baht term, 29% in local currencies. So hotels that are doing well are in Botswana and also in Zambia. Management letting rights, we've added about 4% of number of rooms for management letting rights in the third quarter of this year. ADR is up by about 3% in Aussie dollar term. That's pretty much consistent with what we've been telling our investors, that we should see RevPAR growth of low single digit for Australia. But because of the weakening of the Aussie dollar in Thai baht term, RevPAR is actually down 5%. So similarly, if you look at revenues in Aussie dollar term, it's actually up by 3%, but in Thai baht, it's down by about 4% in the third quarter of this year. For managed hotels, we've actually added 3 hotels in the third quarter, all under Tivoli brand, 1 in Portugal and 2 in Qatar. In terms of RevPAR organic, excluding FX, it's actually up 4%. So that's driven by hotels in Thailand, Indonesia, and China. But if you look at total system sales RevPAR is actually down by about 1%. That's from the ramping up of the newly opened hotels. And because of the soft performance of hotels in the UAE and Qatar, pretty much what's been happening in the Middle East, we actually saw revenue from management contract down by about 10% in the third quarter of this year. Next is the hotel pipeline. So it's pretty much the same as what we've been reporting every quarter. So on the hotel investment side, we have about 1 or 2 hotels that we're building each year that's scheduled to be open over the next 3 to 4 years. On the management contract side, we have about 58 hotels in the pipeline, and over 11,000 rooms that'll be open over the next 3 or 4 years. So these are already been signed, and they're being built as we speak, and they should be opening over the next 3 to 4 years. A little bit of an update on the mixed-use business, which is about 15% of the total hospitality business today. So we continue to sell these villas, and as in the third quarter, we've had some selling activities as well. So that's hopefully will be catching up by the end of the year. So we'll get the same kind of like sales proceeds as last year, as we closed 2018. In terms of the pipeline, we still have the 4 projects in the pipeline. So 1 in Phuket, that will be open at the end of this year. And then we have 2 more for next year, one in Indonesia and one in Malaysia. And then we have the office coming up in 2023. For Nantara Vacation Club, we continue to drive the growth through number of members. So in the third quarter of this year, we have over 11,000 members to date, and that's about 23% increase compared to the same period last year. In terms of inventory, we have 224, with the goal to get up to over 500 over the next 5 years. And the main drivers continue to be Chinese, Thais, Hong Kong, Singapore, and Malaysia. And as I mentioned earlier, AVC revenues increased by 4% in Thai baht term, but because of the mismatch in currencies, we actually saw some pressure on the margin. But we're targeting that by next year, we should start to see margin improving back to the same level again. Now, quickly on the food side. We've actually been struggling a little bit, but primarily because of the overall macro in terms of consumption is still quite soft. So because of that, we saw revenue growth of about 1% on the food side for the first 9 months of this year. And because of the negative same-store sales, EBITDA and net profit actually declined by 7% and by 12%. If you look at the stats for the first 9 months, total system sales growth is still slightly negative by about 0.6%. The trend's actually getting better, but that's primarily because the first 6 months of the year we saw negative same-store sales growth. But for total system sales, if you look at in August and September, it actually turned positive already, primarily because of expansion in Thailand and China. Outlet expansion, we have outlet expansion about 6% in the first 9 months of this year. A little bit slower than the usual pace, but that's because we're a bit more cautious because of the current economic environment. Same-store sales is still down by about 2.9% for the first 9 months of the year. In terms of presence, today it's about 64% in Thailand and 36% outside of Thailand on the food side. Today we operate in 27 countries. The number of countries actually increased quite a bit because of the acquisition of Benihana in the first quarter of this year. If you go into the operational stats for the whole portfolio, same-store sales have been on a downward trend over the past 3 quarters, whereas total system sales started to see an improvement over the past 3 quarters as well, primarily because we started to expand more, especially in Thailand and in China. So I'll just go into each of the hub. For Thailand hub, which is still about 64% of the total revenues, today, in the third quarter of this year, same-store sales declined by about 4.4%. So we continue to see a weak consumption, especially in the rural areas. So if you look at the same-store sales between Bangkok versus provinces is still weaker than Bangkok. And also the other thing is some of the outlets that are in the southern part of Thailand have also been impacted because of the slowdown in the Chinese tourists, especially for Burger King and Coffee Club brands. But we continue to expand the number of outlets, so total system sales still grow by about 4.7% in the third quarter of this year. So what we're doing in Thailand is we continue to come up with new products that are innovative. So things like Black Volcano pizzas, durian pizzas, or Bingsu Festival for Swenson's. So those actually hopefully will help customers remember our products and continue to have the loyalty to our products. And at the same time, we'll also continue to open outlets to increase the customer base. So once the economy turns around, then we'll have the loyalty of these customers and the sales will increase as well. For China, which is about 13% of Minor Foods' total revenues, we actually saw consistent improvement in same-store sales trend in the throughout the year, actually for 2018. So in the third quarter, we actually saw negative same-store sales growth of 4.7%. That's still primarily from the weakness in the tier 2 cities. So we're closing down those and opening more in Beijing and Shanghai going forward. For total system sales, it's positive 8.7%. So that's primarily from the rapid opening of Riverside brands, especially in Beijing and Shanghai, as we said earlier. So for China Hub's focus, it's on the Riverside stores. In the third quarter, we opened four stores, and same-store sales showed improving trend every month during the third quarter of this year. For the initiatives for the remainder of the year on the food side for China, we're targeting to open at least 80 outlets of Riverside by year end. And in addition to trying to boost sales within the stores by launching new products, we're also looking at expanding the delivery business through new delivery menus as well. For Australia Hub, same-store sales continue to decline by about 2.3%. So that's still because of the weakness of the Australian economy, especially in Queensland. Total system sales declined more by about 12.6%, but that's primarily because we rationalized the number of outlets in Australia towards the end of 2017, and also we divested the Groove Train portfolio in Australia as well. But even though domestically in Australia it's not doing that well in terms of same-store sales, but internationally Coffee Clubs is doing quite well. Whether it's New Zealand, Thailand, or Middle East. So same-store sales growth outside of Australia actually grew by about 6% for Australia Hub. So what we're doing in the fourth quarter of this year is domestically, we're going to drive customer traffic by giving more effective promotions and creating new store concepts in order to improve profitability. Also, we think that we want to have sustainable growth for our franchisees as well. So we're trying to improve the performance and the profitability of the franchised outlets. In addition, we also have the coffee roaster business. So we will also focus on B2B coffee sales, which actually gives us higher margin as well. And then, of course, the last thing is we'll continue to expand our international presence, especially for Coffee Club, because we feel that it's the name that can actually travel in many markets. So we'll be looking at opening more of these Coffee Club brands in many other countries. The most recent one is we actually signed a joint venture in Vietnam to expand Coffee Club in Vietnam. And we should see the first outlet in the beginning of 2019. Singapore, 7% of Minor Food Group's revenue today. We're still seeing decline in same-store sales and as well as total system sales as we continue to rationalize the Singapore hub. So I think in terms of contribution, it will get smaller and smaller for us, for Singapore. But at the same time, what we're trying to do now is, in addition to this, to continue to rationalize, we're looking at rejuvenating the existing brands to capture market share. We're also looking at converting some of the non-performing stores into other concepts inexpensively and make sure that we're not making losses from these outlets. And then we could potentially look at franchising new brands in Singapore as well. But all in all, over the next few quarters, Singapore will become smaller, and by next year, it will probably no longer be a hub for us. Just a quick update on Minor Lifestyle. Minor Lifestyle is very small for us today. It's about 2% of our total net profit. In terms of revenue, it's up by about 10% in the first 9 months of this year, whereas EBITDA is up 17% and net profits up 14%. So we actually saw good first half for Minor Lifestyle, but then in the third quarter, because of the slowdown of the consumption environment overall, we actually saw a bit of slowdown in the third quarter. But all in all, it's still improved for us in the first 9 months of the year. So if you look at the total system sales and same-store sales number has actually been declining in the third quarter amidst the weak domestic consumption. A little bit of an update on the capex and balance sheet. So capex for 2018 will be quite high because of the acquisition of the NH Hotel Group. Going forward, because this is still the old 5-year plan, so we'll update you with the newer capex plan next quarter when we have the approved 5-year plan out. In terms of leverage ratio, debt to equity is about 1.23 times in the third quarter, primarily because we issued perpetual bond of 15 billion baht, which was treated as equity. Going into fourth quarter, as I mentioned earlier, we will manage so that the debt to equity level will be below our covenant, which is 1.75 times. And then this is the 5-year aspiration. Again, because this is our previous 5-year plan, which was approved last year, so we'll come back with a more comprehensive plan with NH Hotel Group in the next quarter or so. But what we can say is that in terms of growth, it should not deviate much from what we have here. So we'll probably continue to see growth in the same like 15 to 20% pace in terms of CAGR for net profit growth. And that concludes the presentation. So I think I have some questions coming online. The first question is, why is net profit, including NH, grow 16%, while EBITDA and revenue grew at a much faster pace? I think that's with the pro forma number. So because okay, this is a page. Because in terms of net profit or margin, NH has lower margin than us, primarily because they have a lot of lease business model, which is very normal in Europe, because in Europe, a lot of the properties are actually owned by government or pension funds, which want stable income, so they rent these good locations out as hotels. And because of that, we have to pay lease to the property owners. And because of that, the margin is lower. So in terms of business model, it's different than ours, so their margin is lower. Plus, at the net profit level, we also have to pay for the interest cost for the acquisition amount as well. So that's why at the net profit level, it's much lower than at the revenue or the EBITDA level. The plan to have our DE level not above 1.75, so that is what I've said earlier. One is the fair value adjustment. Once we have the fair value adjustment in place, if the fair value adjustment is higher than what we paid for, then we have a gain on fair value adjustment, which will help increase our equity base, or issuing perpetual bond will also increase our equity base, whereas the debt level will also come down. So these two will help our DE level not exceed 1.75 times. I think I answered. The next question is, have we seen impact from online food aggregator, and how do we plan to compete with them? I would say that we have seen some impact from the online food aggregators, although not as much as the impact from the overall economic environment, because as I said earlier, the rural area has weaker same-store sales, so that means it's more because of the economic environment. But yes, of course, everyone is seeing the impact from the online food aggregators. So what we are doing now is, in addition to, if you look at our operations, we've always been one of the people that, one of the leaders in the delivery segment. But in addition to having our own strong delivery platform with an app that is very easy to use, we're also partnering with some of the online food aggregators as well, and that also helps broaden our customer base. So we're not only just on our own platform, but we now also on third-party platform, and that helps with the problem as well. The next question is, with addition of NH portfolio, do we expect more competition from Airbnb, given that NH hotels are more in mid-scale segment? We've had a research on this. For Airbnb to be worth using, it has to be more for like maybe more like a big family, maybe 6 people or up, and that will actually reduce the price compared to, the price will be lower compared to if you were to stay in a hotel. But because NH hotel is primarily corporate segment as of today, so because of that, it's usually 1 or 2 people traveling and only for a few days. Usually it's a different segment, so we don't see that Airbnb will be a very big competition for NH. About Chinese tourist trend on Thailand operation in the upcoming high season in fourth quarter, I would say we are still seeing a little bit of slowdown on the Chinese tourists coming to Thailand, but because if you look at the third quarter, our Thailand portfolio actually saw occupancy increase of about 1%, even though there's a slowdown in the Chinese tourists. So that means we actually had other markets that could actually compensate for the slowdown in the Chinese market. So in the fourth quarter, it's still the same thing for us. We still continue to see other markets such as the Europeans, Japanese, Hong Kong, Singaporeans coming. So that will offset somewhat the Chinese tourists. So we continue to expect our RevPAR and our occupancy to increase compared to the fourth quarter of last year. There's a question on the CapEx of 2019. As I said earlier, we are in the process of having our new 5-year plan approved by the board in about a couple of days. So after that, we'll be able to release a number for our CapEx plan. The last question is on whether we would keep NH listed. I would say the immediate plan for us now is to keep the NH hotel listed as we have mentioned earlier, as we've told CNMV earlier, and then we'll assess it at a later stage once, because it's part of it is also part of the plan is also to find financial co-investor, and I think whether to keep it listed, whether to have more free float, that will be more clear once we have the answer on the financial co-investor as well. So we'll keep the investor community informed about a plan on this going forward. That's about it on the questions. So thank you for listening, and we will see you next quarter.